Yes, good evening, guys. Of late, I've been getting questions regarding market structure. Like, how do you get to read the structure of the market? So, most of the guys in the group, in the mentorship group, are failing on reading the structure of the market. So I've decided to do this tutorial regarding the market structure so that everyone can get a clear understanding of what is the market structure. How do we read the market structure? What do we look for when we are reading a structure? So this is also for the students who didn't manage to attend today's class. So this is your video so that you catch up with other guys who managed to attend. So now we are going to look at what consists a market structure. So in this tutorial, I'm going to be talking about uptrends, the downtrends, the sideways or consolidation. Some people might call it range. And then we are going to talk about the swings, whereby we've got a swing high and a swing low. Now, before we go any further, here's the usual disclaimer. I do not provide investment advice, guys, and I am not a qualified licensed investment advisor. All information found here is for educational purpose only and should not be construed as personal investment advice. From the very beginning, I must emphasize, currency trading may not be to everyone's disposition. The NIFOT investor or trader must be keenly aware of all the risks involved and should never trade on funds he or she deems necessary for the survival. If you have some experience with leveraged markets, such as futures or options, you owe yourself a look at Forex. Those who have never traded will find it the purest of all speculative adventures. The same as it is with the different trading styles, gaining and losing popularity over time. People like to use buzzwords like liquidity, market structure, without actually knowing what it means. In this article, I'll be focusing on the widely used terminology, market structure. In its core, it's very simple and correlates with the term trend. But as it is with everything, it's easy to understand the core principles, but hard to master the small difference in a live market data. The time frame does not matter. There can be trends within another trend. The higher the time frame, the better and stronger the trend, obviously, but the basic characteristics of a trend can be applied on any time frame. Now let's look at what constitutes the basics. Market structure consists of three different types of trends. We've got uptrends, we've got downtrends, and we've got sideways and consolidation. We also have what we call a parabolic trend. We're going to talk about this a little bit further in the tutorial. Each subsequent trend and even the trendless sideways movement have specific characters. To understand market structure and ultimately what a break in market structure means and looks like, first we have to understand what the specific signs of each trend are. So now let's take a look at an uptrend. Right. An uptrend consists of higher lows and higher highs. So basically, in an uptrend, market will be moving to the upside. You see, market will be moving to the upside. But then, in that move to the upside, you will get retracements. You will get times when market has to breathe. So when it's moving up, it creates higher highs. You see, market is moving to the upside, preferably say on a daily, weekly, or H4 time frame. Then when it retraces or corrects to the downside, it creates what we call higher lows. You see, we've got higher lows that form, but kindly take note. Take note of the higher lows and the higher highs. You see this higher low, then you look at this higher low. This one never closed below. Same applies with this guy. It never closed below the previous low. Same applies with the higher highs. You've got market forming higher highs, but not at any given time does the current high that has been formed close below the previous high. So that's very important to take note of. Price will be rallying to the upside, higher high, higher low, higher high, higher low. Now let's take a look at a downtrend. Now the same principle applies, but in the opposite direction. During a downtrend, price forms lower lows and lower highs. So price is moving to the downside, and then it's forming lower lows and lower highs. And same principle applies. Every lower low that is formed does not close above the previous lower high. You see, every lower low does not close above the previous lower low. You see, because if that has to happen, that means the structure is violated. It's no longer valid. Now let's look at a consolidation. A consolidating market does neither of the above. That is, it's neither an uptrend, it's neither a downtrend. A consolidating market does neither of the above mentioned until supply and demand are out of balance and price breaks out. Note, please take note, a breakout can occur either to the upside or to the downside, depending on where price is in correlation to the overall structure. Now, basically what this means is, in layman's terms, we are saying until price reaches an area of importance. In this case, I've highlighted a supply area. Now, price breaks out of the consolidation, then it rallies to the upside. In this case, the downside, price breaks out of the demand zone and rallies to the upside. Now here is a tip for you guys, one that I have found out to be a much better way to trade a consolidation. Right, for instance, you can see on the chart market came through from the downside. That means market was in a bullish momentum. The moment you get market forming a range in a bullish momentum, right, then the better the chances if it breaks above to continue with this uptrend here. You see, so market will be coming. Let me illustrate that much better. So market will be rallying from the downside. It's in, and then it starts to range up, down, up, down, up, down. Then when it breaks out of the channel to the upside, when it breaks out of here, when price breaks out of the channel, this is a much good setup to trade than when market breaks out to the downside. The reason I'm saying this, you see, for instance, if market breaks out to the downside here, you see, this trade can be a bit tricky to work around with. Yes, of course, the market can work in your favor, but under normal circumstances, this trade of a preceding uptrend into a channel, and if it breaks to the downside, this trade usually does not work out quite well. But the one that breaks outside to the top of the channel works out much better. See, because there will be liquidity here. You must understand that there will be liquidity on top here. Here, here, and here. There will be liquidity for people who would have been selling, you see, because they've got their stops there, up there. They've got their stops, and we know what stops do to the market. They provide the liquidity for the institutional traders so that price can push further high. So now it's best to trade when it breaks and close above. Same applies when it when market is in a downtrend, right? Market is in a downtrend, then it starts to range. Consolidation, consolidate, 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 consolidate. Okay, let me put the... Then when it breaks out of here at the lower channel support line, then this is a much better area to short the market. Reason being that price has collected stops and it's rallying now, you see, because there will be people with long here. People were going long, saying this area is an area of support, so they'll be going long here, they'll be going long here, they'll put their stops underneath. Then when market triggers those stops, it goes all the way to the downside. So that's the tip that I wanted to give you regarding on how to trade a consolidating market. Now we've got what we call a parabolic advance. This is a very special type of trend, the parabolic advance. People might believe a parabolic move is only limited to crypto, but it is not. Throughout every asset class, you can see some sort of parabolic advance on all time frames, even on intraday time frames. A parabolic advance doesn't, or at least gives you little to no chance to get on board on a pullback, while price moves fast and strongly upward and usually consists of subsequent bullish candles with little to no retracement at all, and is driven purely by greed. A break of that parabolic leads to a break in the market structure, and the speculative driven fast ascent comes to a halt. Now this is what a parabolic basically looks like. So market will be just rallying all the way, non-stop, all the way. So the candles will be something like this, then the next one opens this, then the next one opens this, next one opens, next one opens, next one opens. So you see the trend of the move. Next one opens with little or no wick to the downside, or if it's a downtrend, to the upside. So there'll be like no wicks here. So market is just rallying. That's what we call a parabolic advance trend. Now, there are certain aspects or characteristics that you have to look out for when you are reading a market structure. Things you have to look out for. The moment you open a chart, you need to ask yourself, what are you looking for at a chart? You see? And these are the main things that you have to ask yourself. What is the preceding trend of this structure? Say for example, you are working on a daily structure. Then you open your chart, it's a Wednesday. Then you look at the chart, you're like, okay, Tuesday, Monday, Friday, Thursday, which is the previous days, market has been moving to the downside. But how is the trend in that downside move? Is it a strong trend? Is the momentum that fast? Is market really moving? You see, you get to read your candlesticks. The candles that have been moving to the downside, do they have momentum of pushing price all the way? You see, so it's things that you need to ask yourself. You must ask yourself, where is the price, right? In relation to a chart, price can either be at the top. Okay, let's say this is not what I wanted. Ask yourself, where is the chart? Where is the price? So price could be trading at the top here, you see, or price could be trading at the bottom. Then you open a chart, you see your price here. You see, you should be able to identify instantly, okay, price is in no man's land right now. I cannot risk upside, or I cannot risk to the downside. The moment you decide that, already that's a no-go for you to keep on analyzing that asset, because it definitely means whatever decision you are going to make there is going to be too much of a risk, because there's no clear direction here of what the market wants to do. Ask yourself, is it at a support and resistance area, or is price hitting supply? Is price hitting demand? You see, it's those aspects that you have to ask yourself the moment you open a chart. Say you open USD CHF. Okay, where are we on USD CHF? then you read the structure. You see? Ask yourself, what is the overall higher time frame trend? You look at a monthly chart, look at a weekly chart, look at a daily chart. Look at what is the higher time frame bias. Is market bullish on a monthly? Is market bearish on a monthly? You see, it's those aspects of you getting to know how to read the structure much better. It's very important to be aware of the following. Consolidation can take place at bottoms and at tops. They are not a specific sign of a bottom or a top formation. Right, let's continue. Right, now that we have established a basic understanding of what trends can look like and what they consist of, let's move to the next part in our market structure reading series. So now we're going to have a look at the swings. There are two types of swings. We've got a swing high, and then we've got swing lows. Let's first look at a swing high. A swing high is a failure to close above a certain level, and hence a sign of exhaustion. When price fails to close above a certain level, you get a swing high. The ones that I've marked in blue and red, those are swing high. These are signs of exhaustion in the market. Normally a swing high forms when market is in overbought conditions. So in this case, bulls' exhaustion to push price further high has diminished or is coming to an end. It's important to keep in mind swing highs take place at significant levels, which you must find on the left on your chart. When you look on the chart, which I've illustrated here, you can see we've got this price zone here where there's these wicks here. If you notice, they are all closing below a certain area of interest. That's a swing high to the upside. Same applies here. Market swing high, formed this price zone here, and it didn't even close below, and then it pushes down. This is a definition of a swing high. Same applies here. In all situations, price fails to close above a specific level, and therefore getting rejected and leading into a break to the downside. That's a swing high. Now let's look at a swing low. Swing low is the opposite of swing highs. So the same thing applies to a swing low, but vice versa, where bears fail to push price further lower and subsequently bulls take over control. It's important to keep in mind swing lows take place at significant levels, which you must find on the left of the chart. Significant levels in this instance new areas of demand. See, you can see here we've got a demand zone here. Price started forming swing lows, pushes up, swing low, pushes up, swing low, it pushes up. So in all three attempts of these swing lows, in all three attempts on breaking down and going lower, price fails to break the support level and therefore leading into a breakout to the upside. So these are swing lows. You see, we've got swing low here, swing low here, and if you noticed, the lows are almost identical, as in they are equal lows. In most cases, they are equal lows. Now, let's look at why the levels to the left are very important. The levels to the left of every swing high or swing low is very important. You must be in a position to highlight and see a level to the left of the chart that you're like, okay, this is an area of interest, because these are places where a break in the market structure can occur. If a low or a high has been violated by a candle close below or above, depending on the situation, it implies a shift or continuation of the ongoing trend. Right, let me go back to a swing low and swing high. So what I've just said is, if this candle here, say for instance this candle here, if it had closed above here, you see, if this candle had closed above here, it means this whole structure has been violated and market looks to push further high. Same applies if this candle here had closed above here, market would push to the upside. It means this zone has been violated. It's no longer a valid swing high. You see? Now let's look at a swing low. When you look at a swing low, the opposite applies. You see, if this candle here had closed below the blue line, then this whole structure is now violated. Market will, in most cases, tumble to the downside. Same applies with this candle here. If market had closed below the blue line, it would have kept on tumbling. You see, that's what we call a violation of a structure. It means that area has been violated and no longer holds significant importance in the current analysis. So now you can see why it's important to understand the basic characteristics of a trend. Here's a small advice to you guys. Higher lows in an overall downtrend mean nothing if price fails to accomplish a higher high. That's for your homework. Go and research on what that means. Now, a market structure break. In order to understand what a break in market structure looks like, we are going to have to understand first what an engulfing of a level looks like and what it really means. There are two types of engulfing. We've got bearish engulfing, we've got bullish engulfing. Now let's look at an illustration of a bullish engulfing. A bullish engulfing is when the body of an up candle which is bullish, completely engulfs either the body of its prior candle or a certain demand level. So you can see we've got this huge bullish candle moving to the upside. Look how it closes way above the opening price and the closing price of the previous candle. The bullish candle engulfs the previous candle completely and closes above the previous candle's open. That's an illustration of a bullish engulf. This is pretty simple, guys. You should be able to understand this instantly, but it takes practice to identify it on the market structure. Now, a bearish engulfing is when the body of a down candle, which is bearish, completely engulfs either the body of its prior candle or a certain supply level. Now, the bearish candle engulfs the previous candle completely. Like in this case, this whole candle is engulfed by this guy and closes below the previous candle. That's the illustration of a bearish engulf. So that's what a bearish engulfing looks like. Now let's move on to the next part of the lesson. As we now have established a basic understanding of what engulfing means, we can now move forward onto this article's final topic, which is the break in the market structure. Below is a very simplistic and theoretical approach to depict a violation of a trend and hence leading into a break in market structure at the top of an uptrend. Now you can clearly see price is moving up and it's forming higher highs, higher low, higher high, higher low. Take note of the third higher high, right? Price dipped down, formed this higher low. Now look at this high here that was formed here. It didn't close above this guy so that it's validated as a higher high, but it didn't do that. So now the moment price closes below this high, then this becomes a lower high, right? And when price pushes further down and closes below the previous low that was formed, then we've got a lower low. Then you expect market to move into the opposite direction, because it means this uptrend has been violated here. You see, the uptrend has been violated at the top of the structure, which will probably be a supply level. So this illustration here depicts a break in the structure. So the moment you get a lower high and then forming a lower low, these two here, when it comes back and retest this higher low of the previous uptrend, this is your best area to look for short trades, so that you're expecting market to now push further down with your targets the previous higher low of the uptrend. So this is what it looks like when an uptrend gets violated. Now let's look what a downtrend looks like when it's violated, when we say, okay, no, this downtrend has been violated. So now price will be moving to the downside, forming lower highs, lower low, lower high, lower low. Then we've got a lower low here, but price violates the previous lower high and then doesn't form another lower low. You can see there's no lower low when market dips down again, then it pushes further, doesn't form another lower low. In fact, price is at the same price area. Then this guy comes in, it forms a higher low. You see, we've got a higher low here which has been formed after this guy. Higher low, higher low. Already we've got the baby steps, the infant stages of a uptrend, market moving to the downside. The moment it breaks above, you see we've got a channel here, consolidation at a important level of the structure. We've got a consolidation market, then price breaks to the upside, you load your longs, price pushes further high. Then we've got higher low, higher high, higher low, probably another higher high. You see, so this is an illustration of a break in market structure at the bottom of a down trend. To conclude, in the end, do you understand why it is important to keep an eye on the trend? Because the trend is your friend until it isn't. Use the trend to your advantage. There's money to be made both ways, and you can easily spot the shift of a trend and hence change your directional bias quicker. This way, if you pay attention to what the market is telling you. Thank you for watching, and I hope you have found some value in this article. Remember to always back test any approach first by paper trading, or you can call it demo trading. If you have any questions, comments, queries, you can hit me up below there, comment, and then I can have a look. If you have any questions and you are in the mentorship group, just send me a message on the private chat so that we can discuss further, so that you get to understand more. And for those who haven't subscribed to my channel, you can click the subscribe button below there and make sure you've got the bell icon clicked so that you get notifications every time I upload an educational video regarding forex trading. I really appreciate your support. Subscribe to my channel and get more updates as soon as they are uploaded. Thank you once again, guys, and have a great evening. Bye bye for now.